The way I built up my portfolio was investing consistently over time. But what does that mean? How often was I investing? How much was I investing? And what is the right way to invest consistently to build up your portfolio? In this video, I'll not only go over what I did to build up my portfolio, but offer some tips on how you can do the same. So let's create a plan to invest consistently. Let's go. Now, you've probably heard of dollar cost averaging by now. This isn't a video on dollar cost averaging, but if you're investing consistently over time, that's pretty much what you'll be doing. Now, the magic of dollar cost averaging is that you won't be paying the same price each time because you're buying at different intervals and the price changes over time. When the stock market is down or when the prices are down, you're buying more of the stock or the fund, and when the prices are up, you're buying less. Now, there's been tons of studies on dollar cost averaging. Of course, you've probably seen many of them, but in general, it works really well in a falling market or a flat market, but it doesn't work as well in a rising market because the prices will be going up over time, so you're getting less each time. And generally in history, the stock market does go up over time. But since most people don't have a lump sum to invest up front, some people do, but most people will be taking either a salary or a regular income and investing a tiny portion of that over time and investing consistently that way. So that's what we're going to talk about, is how to invest consistently when you've just got a small amount to invest over time. So what I did when I started investing, the first 5 or 6 years, I would save up $1,000, sometimes $2,000. It would take me about a month, and each month I would put that money into the stock market consistently. I'd also invest any extra money that came in, so tax refunds, or if I'd sold something and got some money for it, things like that. So any extra money was also put into the stock market during those years. So each month I would log into my online broker and buy a new company or add money to an existing company that I already held. I'd already done the research up front, so I knew which companies that I wanted to buy. I would do research on the companies that I wanted to buy every 6 months. It wasn't always every 6 months, sometimes it'd be every 12 months. So I already had a list of which companies that I wanted to buy. At the time I was buying single companies, but this also works if you want to get into index funds or exchange traded funds as well. In fact, it can actually work really well with funds because you're building up the same fund over time, so you don't have to keep thinking about what companies you're going to keep buying. That's pretty much what I did consistently. Every month I would put, say, 1,000 or more. 1,000 was my minimum, but I'd often have more into the stock market, and I was buying single companies, and I was just doing that over a long period of time. And by the end of the period, which was just close to 6 years, I'd built up a few $100,000. So work out a time frame that makes sense for you. For me, it was monthly, but for you, it might be every time you get paid, every time your salary comes in, that you put a certain amount away, that you build up to a certain dollar amount that you want to invest. But how much should you be investing each time? So clearly how much you have to invest is going to vary from person to person. It really depends on your income and your lifestyle and your expenses. I was pretty frugal at the time, so I wasn't spending a great amount on everyday things. I was just living to the basic needs that I had, and I was using most of my money to put into the stock market because that was really important to me at the time. I knew that that money was going to pay off in the long run, so I was pretty patient. I did not have a set day each month that I would invest. Generally, it was towards the end of the month, but I was pretty flexible on that. If there was, say, a dip in the stock market, like a mini fall where it's dropped about 2 or 3%, I would actually go in and see if I had enough money in my investment account, and if I did, I would buy then. So I didn't have a set day during the month that I would buy, but I was consistently investing each month. Just the day varied. It's actually an advantage to be a little bit more flexible because then you can take advantage of those little price fluctuations. So say you're like me and you've decided that you're going to invest a minimum of $1,000 each time. Where do you keep that money? It really depends on what's required of your online broker. You will need an online broker to make trades, to buy and sell those shares. Most of the big ones are NAB Trade, CMC, CommSec. I use CommSec. It's not that I particularly recommend them, it's just who I'm with. I quite like their research tools, but they are quite expensive for trades. Some online brokers will allow you to trade directly from your regular transaction account that you use every day, and others want you to open up a separate investment account. So just see what your online broker wants and just do that. Once you've opened up any accounts that you need, you're ready to go. So say you've saved up your $1,000 or however much you want to put into the stock market each time. What do you buy? So it's a good idea to do your research up front. I do this roughly every 6 months, or sometimes it was longer. Generally, my list wouldn't change all that much each time I did it because the criteria of the companies that I was looking for, they were pretty stable, so they didn't change that much each time I did the research. So knowing that actually made me even more confident to buy these companies because they're on my list all the time. They always fit my research criteria. I did have a different strategy then when I first started out than I do now, mostly because I didn't really know about dividend investing then and I was just doing what most other people were doing. So when I first started out, I was trying to use a more value strategy of investing, pretty much close to what Warren Buffett was doing at a time because I'd read a book and I was trying to use a similar strategy to that and look at financials like that and then just adapt them to the Australian market. Now, of course, I'm a dividend investor. I kind of wish I had started off being a dividend investor right from the start, but I didn't know what I didn't know then, and so I'm just letting you know what I did. I do believe there's not one right way to invest, but there are many smart ways to invest. So you need to find a strategy that works for you. There are different research methods. I have a few on my channel already if you want to look at some of the different methods of trying to choose companies. But it is important to do your research up front so that when you are ready to buy, you already know what companies you want to purchase. If you are just starting out, make sure you stick with those well-known companies that everyone knows about. These are the companies that have been around forever, and so they're likely to be more stable. Have a look at the stock chart over 10 years if you can, and just make sure that the price is going up consistently over that time. There's going to be small dips each time the market goes down, but generally over 10 years, you want to see that it is rising. If you're investing for the dividends, you want to have a look at what dividends they've paid in the past and to see how stable and to see if they're growing. There are other financials to look at, but those will give you a base to know if the company that you want to invest in is going to be stable or not. You're mainly just looking for consistency, growth and stability. All of this information is going to be in your online broker. All of them have pretty good research tools. You can even find most of this information online as well. If you're looking at single companies, you want to make a list of between 10 or 15 different companies that you want to buy. The reason you want to buy that many is you want to diversify your portfolio. Just putting your money in 1 or 2 companies is a lot more risky than if you spread your money over several different companies. If you want to invest in exchange traded funds or index funds, then you only really need 1 or 2. If you're going to get more than one, like 2 different funds, then make sure that they're different and they just don't hold the same companies because you don't want to be repeating the same fund. If you're going to have more than one fund, you want them to be different. And then just start buying them. There's no order to which you have to buy any particular company. If you have a list of 10 or 15 different companies, then just choose one that looks good at the time that you're ready to buy until you have your full list, and then you can start building them up separately. If you're just having one fund, that makes it so much easier. You'll just be putting your money into that one fund. If you're interested to know what I hold right now in my portfolio, I have 14 different companies and 2 exchange traded funds. So if you're buying single stocks, once you've actually bought all of the companies, how do you then build them up? Do you put the same amount into each of them, or do you concentrate on 1 or 2 companies? So if you're investing consistently, you don't need to be putting the same amount of money into each of the different companies. I usually concentrate on 2 or 3 a year that I want to put my money in and focus on. They're usually the ones that are doing the best for me, and because I'm a dividend investor, they're usually the ones that are paying the best dividends and are the most stable. There are companies that I have only a little bit of money in, and there are companies that I have a lot of money in. So I don't have even amounts in all of the companies, but I do like having a diversified portfolio. Just put your money where it's doing the best at the time. So that's pretty much how to create a consistent investment plan. You need money to invest, so consistently putting money into the stock market. If you can do that monthly, that would be great. So what happens when you start investing consistently over time? 1, it becomes a habit, so it becomes easy. It's just another financial thing that you do. And 2, not only is the money that you put in going to be increasing your portfolio, time is also going to be working in your favor. You've heard of compounding interest. That works brilliantly in the stock market, and you'll be surprised. Not so much when you start, because it seems like things take forever in the beginning, but over time you'll be so surprised at how it starts to grow. So that's really the key to consistent investing. So you've got a consistent schedule, a consistent amount that you're putting into the stock market, and a list of companies that you want to buy, and you're letting time do its magic. That is how you consistently invest, make it a habit, and it becomes part of your life, and you can build your portfolio over time and reap the rewards. I really hope you found this video useful and you start putting a consistent investing plan into your own lives. I'll be showing you more on how to do research in the future, and I hope that you find that useful as well. For now, happy investing, and I'll see you in the next video. Bye.